On behalf of RAIN, we welcome all the participants to the first quarter 2020 earnings conference call of RAIN Industries Limited. The speakers on today's call are Mr. Jagan Reddy Nellore, Vice Chairman of RAIN Industries Limited, Mr. Gerard Sweeney, President of RAIN Carbon Inc., and Mr. T. Srinivasa Rao, Chief Financial Officer of RAIN Industries Limited. During the call, management will be referencing and discussing a slideshow presentation which is available for viewing on our website at www.rain-industries.com in the Investor Relations section. It is recommended viewing this presentation while listening to the management's discussion. Before we begin, management would like to mention that some of the statements made in today's discussion may be forward-looking in nature that could be affected by certain risks and uncertainties. The company's actual results could differ materially from such forward-looking statements. Now, if you could turn to slide 3, and I would request Mr. Jagan Reddy to provide an update on key developments within RAIN Group. Thank you, and over to you, sir.
Thank you. Good evening to everyone. I hope you are all well and staying safe during this challenging time. Here at RAIN, we have been fortunate during the global coronavirus pandemic, touch wood. In every country except in India, where stay-at-home orders have been implemented, our plants have been designated as essential businesses or have received requisite approvals to continue operations because they support the critical industries such as aluminium, steel, carbon black, and petroleum refining industries. On slides 3 and 4, we provide a few key highlights on how we have been doing everything possible across our global organization to keep our people safe and plants operating so that we remain a strong link in the global supply chain. For example, non-essential employees are working from home to reduce the risk of contaminating those who are critical to our production process, and we are using our chemical know-how to produce our own cleaning agents with disinfecting properties. In addition, our global safety, health, and environmental group has been in continuous contact with the employees at our facilities and those working from home to ensure they have the latest information about the virus and best practices to remain healthy and safe. We are acutely aware that continued operation of our plants is not only crucial for RAIN, but also for the broader global economy and in our local communities. To date, our diligence, knock on wood, has paid off. I am proud to tell you that since the World Health Organization declared a global pandemic on March 11th, we have had 0 work-related coronavirus cases among our employees. Turning to slide 5. As a result of continued operations, I am pleased to report that we had a reasonably good first quarter. Our adjusted EBITDA of Indian rupees 5.58 billion during Q1 was a 23% improvement over the Indian rupees 4.54 billion that we recorded in the fourth quarter of 2019. Other than the second half of March month, the first quarter went pretty smoothly, much as expected, with the positive conditions from the fourth quarter carrying over and volumes and margins holding firm. We are pleased that our earnings improved sequentially as business conditions remained positive. By mid-March, however, the situation became extremely uncertain due to the pandemic and the oil price war between 2 large oil-producing nations. The resulting collapse in oil prices had a material impact on our BTX, carbon black oil, and fuel oil products, which traditionally are highly variable to begin with. The volatility in this case, though, was exceptional and unique, prompting us to take rupees 900 million write-down at the end of quarter 1. As you are aware, the impact of the oil price and collapse in oil consumption has had broad repercussions across the global economy. While our Q1 inventory adjustment was exceptional, our consolidated performance was in line with expectations. In our carbon segment, Q1 EBITDA was up 14% compared to the prior quarter, though revenues were flat. This was the result of stronger than anticipated demand and dislocated orders that we picked up due to the early impact of coronavirus on China and their inability to export shipments to global customers. As a result, we gained some unanticipated spot CPC volumes. The shutting down of the global economy over the last few months has resulted in swings in many commodity prices, which have gone in both directions. Of greatest concern to us has been the impact on global refinery runs, which has affected us to varying degrees to this point. While CPC prices began to rise early in Q1, they later weakened with the reopening of China. Likewise, GPC prices were initially weak but have strengthened due to reduced refinery runs, which cut GPC supplies in various parts of the world. We are watching the specific developments going forward as recent events have pressured CPC prices while GPC prices have increased. This margin pressure should be short-lived but will largely depend on the availability of GPC going forward. On the pitch side, our carbon segment, our performance was in line with expectations for the first quarter, aided by increased volumes in Russia and the restart of major North American smelters. Pitch prices have declined consistent with commodity prices and coal tar prices, which protected our margins. The major area of concern for us has been cuts in metallurgical coke production, again consistent with the impact of global pandemic. Reduced steel production and shutdowns at several plants have resulted in a 35% reduction in coke production capacity. We do not foresee this being an issue for us as we have taken several countermeasures to secure additional supplies as a safeguard for our distillation business going forward. In other carbon products, volumes of carbon black oil were down in first quarter because of combination of factors including impact of coronavirus on economic activity, loading issues at our facility in Russia, and lower auto sales, which showed a 20% year-over-year decline. And that's really saying something, since 2019 was a very bad year for the auto industry. Conversely, creosote volumes were quite strong during this quarter, and we expect second quarter to be robust as the North American rail industry appears to be using this period of reduced travel to ramp up track maintenance. Turning to our advanced materials segment, revenues improved marginally compared with previous quarter, while EBITDA doubled compared to the fourth quarter of 2019. During the quarter, our engineered products business operated at full production capacity for our PetroRes coating product for lithium-ion batteries, thanks to solid electrical vehicle sales. Volumes of our CARBORES specialty carbon were also strong during the quarter, and that continued into April. More recently, though, we have seen this volume moderate as European plants reline their blast furnaces. Our resin sales during the quarter were strong, and our commercial team has been successful in gaining price increases as we transition our traditional product offerings to a competitive value proposition tailored to customer needs and requirements. In March, we also ceased production at the Uton facility in the Netherlands and have successfully shifted production of profitable resins to our Duisburg plant in Germany. Just as significant, the closure of Uton will eliminate approximately $10 million in annual fixed costs without adversely impacting resins production or profitability. Moving to intermediates, the oil price war had a big impact on BTX, and petroleum pitch volumes fell significantly. The petroleum pitch reduction was due to reduced distillation as fuel oil prices were too high as speculation about IMO's rules and inflated prices and impacted availability. This is clearly no longer an issue. Naphthalene derivatives also saw lower sales during this quarter and were impacted by disruptions in our system due to electrical outages that resulted in several days of lost production at our phthalic anhydride plant. On our cement business, despite increase in revenue by 10% compared with the previous quarter, EBITDA remained flat. This was primarily due to a decrease in realizations in all the key markets as a result of sluggish market conditions. With this business update, I will now turn over the call to Jerry Sweeney to take you through the industry and other business updates on slide 6. Jerry?
Thank you, Jagan, and good evening, everyone. It's a pleasure to speak with you all again. Turning to slide 6, global aluminum production increased by approximately 2.7% compared to prior year quarter, primarily related to China and the Middle East. With most automobile and airline production facilities idled due to the pandemic over the last few months, clearly demand is falling for primary aluminum. The aluminum industry is heavily reliant on these industries, and we are pleased to see them slowly coming back into production due to the reduced demand. One North American smelter in the Pacific Northwest announced their closure during Q2, and others began to reduce amperages to their cells to keep production lines operating, lowering metal quantity in preparation for sale to the LME to turn cash. We are and will continue to watch these developments moving forward. Turning to our major capital projects on slide 7, we lit the flare during March and began to feed C9 resin into the hydrogenation reactor of our new hydrogenated hydrocarbon resins facility. This was a major accomplishment by our team given the unprecedented operating environment they continued construction in. We're very excited to have reached this point since customers have been anxiously awaiting production of our new Novares pure water white resins. So far, the product quality has been as planned, and we are excited about the potential it brings to this business. Commercial production has begun, and we are preparing commercial-sized test cargoes for our customers to perform technical testing of the product, which will take several months. We anticipate that HHCR will contribute to our earnings by year-end. Shifting to India, we had to delay the startup of the vertical shaft calciner due to the impact of the coronavirus. Given the uncertain global situation, we now expect to commence operations in Q3 2020. We also temporarily stopped the construction of anhydrous carbon pellet production facilities in the U.S. and India to minimize the possibility of coronavirus exposure during this peak period to our existing operations. We now expect to commence operation of our ACP production facilities in Q1 2021. With regards to developments in India, we are awaiting the finalization of the national SO2 emission standards for the calcining industry. The release of these standards appears to be the linchpin to clarification on the restrictions imposed almost 2 years ago on the import of GPC and CPC. As we've stated in previous calls, our existing BISAC plant and the new shaft calciner have scrubbing systems that can remove at least 98% of SO2 emissions. So we are confident in our ability to meet any new standard that might be imposed. Looking ahead, Q2 is traditionally our strongest quarter as industries come out of winter and ramp up their activities. That will not be the case this year. Q2 demand will be down due to these unprecedented events. Our major focus is on the forward outlook, meaning how quickly global industry will restart and ramp up, and how it will impact demand for our products. During the second quarter and until demand returns, we see reduced global demand for aluminum, tires, and other automotive components due to the temporary closure of many automobile and airline production facilities that could have a cascading effect on demand for our carbon and advanced material products. We are prepared with contingency plans in the event of reduced demand for our products. We're taking nothing for granted in these uncertain times. We've ramped up cost reduction programs already in place, watching plant profitability so we can act quickly, reducing capital expenditures where feasible, and closely monitoring liquidity to ensure we can weather the next 2 quarters. We are a versatile company that has seen many fluctuations in market conditions over the years. We will continue to monitor the market conditions and react based on circumstances that confront us. While the markets are fluctuating in an extreme mode currently, we are comfortable and confident in our position as a converter to maintain our margins and remain competitive over the medium term. With that, I will now turn the call over to Srinivas, who will take you through the consolidated financial performance of Rain. Srinivas, over to you.
Thank you, Jerry, and good evening, everyone. It is a pleasure to speak with you today. In the first quarter of 2020, the company achieved consolidated net revenue of 28.82 billion rupees compared to 31.78 billion rupees in the first quarter of 2019, a decrease of 2.96 million or 9.3% decline. This resulted from decrease in revenue of 2.18 billion or 10.2% in our carbon business segment and a reduction of 0.44 billion or 5.7% from our advanced materials business and 0.34 billion or 12.5% reduction in our cement business segment. Rain's consolidated adjusted EBITDA increased by 1,915 million rupees compared to the prior year. This resulted from an increase in the carbon segment by 1,801 million rupees and increase in advanced materials by 287 million rupees, offset by a decrease in the cement segment by 173 million rupees. Now turning to next slide on the carbon segment performance. Slide 9. Revenue from our carbon segment was 19.15 billion rupees for the quarter ended March 31st, 2020 compared to 21.33 billion for the same period last year. During Q1 of 2020, the average blended realization decreased by 19.1% due to changes in industry-related dynamics, which was offset by the favorable increase in volumes due to the timing of the shipments and impact from the appreciation of US dollar against Indian rupee by 2.9%. Gross sales volume in the carbon business segment increased by 11.1%, mainly due to an increase in CPC by 17.4% and an increase in CTP volumes by 12.1%, which is offset by decrease in other carbon products by 6.7%. Overall, due to the aforesaid reasons, revenue from carbon segment decreased by 10.2% in Q1 of 20 as compared to same period last year. Adjusted EBITDA of the carbon segment increased by 1,801 million rupees due to increased volumes and margins in CPC business, as well as having worked through inventories of high-cost raw materials compared to prior quarters. Turning to next slide on performance of advanced material business segment. Slide 10. Revenue from our advanced material segment was 7.24 billion rupees for the quarter ended March 31st, 2020 as compared to 7.68 billion for the same quarter last year, a decrease of 0.44 billion or 5.7%. During Q1 of 2020, there was a 6.7% decrease in volumes, which was driven by reduced production due to scheduled maintenance, weak demand from the North American construction industry and European automotive and adhesive industries, and as a result of the closure of our UTAN facility in the Netherlands. During first quarter of 2020, the average blended realization increased by about 1.1% due to change in the product mix. Due to the aforesaid reasons, revenue from the advanced material segment decreased by 5.7% during first quarter of 2020 as compared to the last year. Adjusted EBITDA of advanced material segment increased by approximately 287 million due to improved absorption of fixed cost of existing facility by shifting resins volume from the closed facility in the Netherlands to Germany. Moving to next slide on cement business segment. During the first quarter of 2020, cement revenue decreased by 12.5% compared to the same quarter last year due to decrease in realizations by 6.6% and decrease in volumes by 6.3%. Due to lower volume, cement EBITDA decreased by 17.3 million in the current quarter as compared to last year. Moving to next slide on debt. We ended the first quarter of 2020 with a total debt of 1,168 million, including 72 million of working capital loans and lease liability of $74 million recognized due to implementation of new accounting standard on leases. Net debt was 1,003 million. It's about $1 billion and based on LTM EBITDA 273 million. We ended the quarter with a net debt to EBITDA ratio of 3.7x. Despite the ratio being above our target level, we are still comfortable here as our average borrowing cost stood at 5.2% and we expect it to remain stable since the floating rate portion of our long-term debt is tied to Euribor, which is still negative. Cash flow on capital expenditure and plant turnaround costs for the quarter totaled about $60 million, of which $29 million was for our major growth projects. Given the completion of HSCR plant in Germany, the high cash outflow related to capital expenditure is not a surprise. Regarding liquidity, we ended the quarter with $165 million of cash in hand and $162 million of undrawn revolving credit facilities. Given the current circumstances, we are watching our liquidity position very closely in all regions to ensure that our ability to access credit lines is not hindered by performance. While we have not been put in a position to proactively draw on our lines of credit as of today, given the current economic situation, monitoring of the situation has become a routine task. In addition, we continue to evaluate various government assistance programs in all the countries where we operate. So we are prepared to access them when appropriate and to protect the jobs of our employees when we can. Current uncertainty has also caused us to increase monitoring of capital spending, further increases our cost saving programs and reduce credit lines to customers. These efforts will position us to weather the storm that may come in a year where we are completing strategic capital projects. With that, I will now turn the call over to the operator to start the Q&A session. Operator.
Yes, sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Chirag Singhal from First Water Fund. Please go ahead.
Hello. Thanks for taking my question. So just a couple of questions. First, what kind of margins we will be expecting from the HSR plant?
See, we just started operations, and so once hopefully we should stabilize sometime during the towards the end of third quarter, and starting fourth quarter we should be fully operational. And we just started, so we cannot comment on the thing. But when it's running at full capacity, the margin should be, the EBITDA margin should be well about 35%.
Okay. And sir, now coming to the volumes in the current quarter, as you mentioned in the commentary that we already are seeing lack of demand and all. So what kind of volume loss we will be seeing for the current quarter?
You mean this is the second quarter?
Yes.
Second quarter we cannot comment at this point of time because things are little. We have seen some performance during the first half, and now we have to see how it goes on in the second half. For the first half, it was not so down, But as you are aware, with this COVID crisis, we really don't know what is going to happen tomorrow. So we cannot comment on the current quarter's performance, but we know it will be weak.
We have not seen any decline in the first 45 days of the quarter.
Sorry?
First 45 days of the quarter, we have not seen a big fall.
Okay, all right. But you can give me the capacity utilization rate, right? A tentative capacity utilization rate at the current level?
We cannot give by month and other things because we don't have the habit of we don't have the policy of giving out monthly production numbers. So we cannot comment on that, and especially commenting on during this crisis time is not the right thing.
Yeah, let me jump in at this juncture. I mean, to give you as much of a response as we can at this time. If you note from our comments, we have a lot of moving pieces. It's not just a volume aspect here. We have pricing and margin pressure in some of our liquid products and such. So we have a lot of pieces that are moving. That's why, as Jagan rightly put it, and as we've already said in our commentary, the second quarter is clearly not going to be a strong quarter for us, which it historically has been. And we already are acknowledging that it's not going to be as good as our first quarter because of what's taken place, which is impacting volumes, which is impacting our margins in different areas on different products. So it really is a very evolving situation that regardless of how you look at it right now, it's a complex change from where we usually are.
All right. Okay. So just one last question. Sir, on the inventory loss, so will it take a quarter to normalize for the inventory loss, or will we see laggard, will we see the extension of the inventory loss in quarter 3 as well?
No, it's not anticipated. We don't normally, we do have fluctuations, especially in our liquid products category. We do see fluctuations of our product prices. They're commodity based, right? So we see fluctuations from quarter to quarter, from week to week, from month to month. We don't normally take write-downs related to that. However, due to the pressure from the crude oil prices in 4 different product categories, it was a 70% drop off in values. That's what necessitated the first quarter write-down. There is no follow-on contemplated to that. We have even seen some recovery of the crude oil price of late, but we do not expect that event to carry on.
Okay. All right. That's it, sir. Thank you.
Thank you.
Thank you very much. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We take the next question from the line of Rohit Koti from Marshmallow Capital. Please go ahead.
Thank you for the opportunity, sir, and thank you for a detailed update on the current scenario. My first question is on our capital structure. So I think we had a very efficient capital structure, but with the changing facts, have we changed our opinion on if capital structure should be changed so that we have more equity and less debt? So broadly, do you think that we should pay down when things normalize a little? Do you see yourself paying down the debt to bring some more redundancy into the capital structure as compared to before?
I would say, Jagan, you can have a final say on this. I would say in the current circumstances, our major focus is our operations and our cash flows, right? Making sure, I don't think in the throes of what's taking place that we've given consideration to our capital structure. We're very comfortable with with it as it exists today. And the only other thing I would say is our focus is always to pay down our debt wherever possible, and we'll be keenly focused on that going forward as we emerge, from this crisis.
Just to add to that, basically, we have a debt that is payable only in 2025. We have no payments for next 5 years. So from a debt perspective, we are pretty comfortable. And as you are aware, we have been spending, quite a bit of funds, internal accruals for expansions, be it the HSCR project or the ACP project or the Shaft Center project in India. So, but now I think, hopefully these projects are completed. We have no new projects in pipeline. So all the cash accruals that may be collected and going forward can be used for debt reduction, please. Thank you.
Great point.
Okay, understood. That was helpful to know. So the second question I have is, so in the last year, towards the end, you had mentioned the intent to bring debt to EBITDA to 3x. And I understand that with this current scenario, that target, the time period at least where you're targeting, that would have changed. So if you could speak a little about that, if you think it's relevant. And the second question in debt itself is that there is mention of covenants in the annual report that we have on our two facilities, the term loan as well as the bond that's maturing in 2025. How much of a cushion do we have in those covenants, and is that something which is, let's say, in the top 5 things that you worry about over the next year, or is it that we are quite comfortable? And if it is possible, it would be helpful if you can share the covenants in a separate press release.
First of all, on covenants, I would like to address is we don't have any covenants. Mainly incurrence covenants. Means if you want to borrow additional funds, then only we have to achieve those covenants or maintain those covenants. Otherwise, just for a normal operations, we don't need to worry about any of the covenants because we have our debts are covenant free, except during incurrence. Second is regarding the debt to EBITDA. As I said, basically, first of all, with our capex projects, the new projects starting up and the markets for most of the products, and our cost cutting, and we expect our EBITDA to improve very well and to increase well. So, and meeting the debt to EBITDA ratios as we targeted, and along with any repayments, with all the surplus cash, we are pretty comfortable meeting those debt to EBITDA ratios.
Oh, thank you. And one last question from my end is, obviously the GPC, anode grade GPC availability and coal tar availability are extremely vital to our organization, as is very obvious. So, in the current scenario and over the next few months, how, if you could give us a little more color on their availability across the geographies that we operate in, India, Europe, and North America.
Jerry?
I'm happy to do that. We'll start with coal tar first. We have very strong relationships, long-term relationships for our coal tar supply. However, this unique circumstance left us quickly moving to shore up to make sure that we have enough supply. Because we do have the opportunity to continue to run at full rates on pretty much full at all of our plants worldwide. So we've done that. We have contingency in place for if we have any spot disruption of supply due to curtailments. We're comfortable with the plans we have in place for a kind of a plan B type of scenario. And that's mainly because while we have right now a global pandemic, how economies emerge, whether it's Asia, Europe, or the Americas, can be very selective moving forward. And so we're watching that carefully, but we're very comfortable with our tar supply and our plan B, that if we need to move to it, we can move seamlessly into that. On the GPC side, anode grade GPC side, as you said, and as we've commented, it is a murkier situation, and that's just because for what I really described from the tar side and global steel production, you now take that over to refining. What we've seen to this point is we've seen reduced refinery runs because, consistent with the reduction in demand for transportation fuels. And as such, they're just not running refineries and cokers as heavy. Right now, the major area that we see of impact, and it is pretty much globally, is ultra low sulfur coke. And in that area, we've seen for these conditions, you might say that ultra low sulfur coke has abnormally risen in price in an environment where you really wouldn't expect it to be rising in price. And that's just purely from a demand and availability dynamic perspective. However, technically, we're comfortable with our ability to get adequate raw materials. It's just obviously, as we commented earlier, at what cost, and that's what we're acutely focused on, so that we can maintain our margin and reach expectations in the business.
Thank you. That's it from me. I'll get back to the queue. It's always a pleasure listening to your con calls.
Thank you.
Thank you. The next question is from the line of Akhilesh Kumar from Explore Technologies. Please go ahead.
Yes, thank you for taking my call. I joined late. If you have commented already, you can skip. I wanted to know about the GPC allocation. You have not informed in the presentation. What is the status on that? And have we got allocated for our new plant as well?
See, basically, we expect the new allocation to be given next week for the financial year 2021 because of this COVID crisis, there has been delays associated with that, and now finally, hopefully, we should have the allocation next week. And in regard to the new plant, also we are applied, but we also will know early next week about the status of the same. But we have contingency plans also for that, so we should be on all right.
Okay, and there was a complaint from others that regarding import of ACP. Is there any update on that?
No, actually, as you may be aware, we did actually import a small shipment into India, and then subsequently, there have been some queries. We addressed them, but we don't have any response from them back again. So
we are ready to go. Okay. I have one more query regarding HSCR plant. I remember in earlier calls, Jerry has been informing us that many of our low value raw materials will be consumed by HSCR plants. So in value terms, how much it will be there that we will be using our in-house raw materials for that?
See, let me put it this way. While we'll be procuring both in-house, we cannot mention exactly what is that, but I can tell you one thing is, based on our patents, what we have filed for the HSCR project, probably we will be, as a raw material cost, we'll have probably one of the lowest raw material costs for any HSCR plant in the world. So all I can comment is that, because our R&D team was very successful in actually in trying to use raw materials which are not used by others, so to substantially reduce the cost.
So
I can say that.
Okay. On working capital requirements front, like say, we will be seeing the increase substantially from that plant, right, going forward?
No, not really, because the impact should not be much, because the raw materials, as I said, some are in-house. For example, the raw materials we are now using comes 100% from in-house. But as we grow, it may not be sufficient. So we may purchase from outside, but overall cost of the raw material may not be that high. So, and one good thing is, for example, if the HSCR prices are down now, so is our raw material price. So we always target, like in any other business, be it the calcination business, distillation business, our target is always not on the top line, but the margin what we make between the delta between the raw material price and the finished product price.
Okay, that sounds great. One last thing, we are hearing a lot of news regarding China and chemical industry moving out of there, and subsequently, do we have any impact, positive or negative, on our chemical products in Europe?
No, we do not think, but see, whatever happens, basically, I think, for example, European Union has announced some COVID package yesterday, and the US has announced before. All these should actually add to us, basically they should benefit us. So it should be good for us.
Thanks a lot. That's it.
Thank you.
Thank you. The next question is from the line of Arvind Kothari from Rain Industries. Please go ahead.
I had a question regarding the fixed cost of our business. So if for a period of a quarter, for example, if the demand is very weak, so what kind of fixed cost we would be working with of the plants, even if the demand scenario is not great? I mean, to just figure out how much debt could increase if the demand scenario remains low for a year or so.
See, that's a very difficult question to say because, we don't know how much is the demand going to go down. So we have the flexibility to reduce, shut down a plant. Let us say if it's 6 months or 8 months or 9 months, if the demand is going to come down, then we have, as we operate several plants, basically we have the ability to shut down the plant, which means, basically we will shut down our most highest cost plant. So we should be able to manage to a certain extent, on the fixed cost to a certain extent. But again, there are SG&A costs and other things which cannot be managed. But being in the developed countries, actually being the European Union or the US, basically we have they are supporting quite a bit there with COVID packages and other things. So we should come out all right. But again, today we are in a very uncertain situation. So making any guesses now is difficult. So anything could be, So that's why we cautioned in our annual report we cautioned here that because we are not aware basically how this will unfold. Not only us, nobody is aware. So we don't want to really comment on second quarter, please.
Yeah, what I'm happy to offer related to your question is that from a major products perspective, be it calcined petroleum coke and coal tar pitch. Our volumes, while a bit reduced, are still moving. So that's the very reason that our operations are still going. So we've not seen, to what Jagan's saying, is we've not seen a major impact to this point that's of great concern. What we need to watch is what is going to continue to happen with these industries as this continues to play out. Obviously, with producing the products, and especially our liquid products, it comes down to the margin aspect of the volumes that we're selling. In those areas, we are seeing, reduced demand for the liquid products. Obviously, we're seeing, very much reduced prices and everything. And so, while on the major product side, we're more comfortable. Beyond that, right now, we are producing some products that we're having to push into a market that doesn't necessarily want them. That obviously never favors you from a margin perspective. So this is what we're faced with. I want to just indicate that's why we make a statement like, look, we're comfortable with weathering this, but from a profitability perspective and where we'll wind up, it's still a too fluid a situation.
Correct. So another question was relating to this only. So I mean, our capital allocation has always been to, go for capexes for a lot of projects that we, earlier had seized the opportunity. But given the current scenario now, the demand scenario, so going forward, are we willing to alter that in terms of favoring debt payment more over newer capexes, or how is the management thinking about the future whenever things settle down and whenever we have normal demand coming back and cash flow coming back to our company?
No,
what would be the priority?
We did address this question before. I don't know if you were there on the line, but we did address this. Our target is
I was not
we
there,
have no new projects. We have no new projects, and our target will be debt reduction going forward with the cash available.
Okay, great. One last
Thank you.
Thing for Srini, if cement prices, you can guide, have we increased that? Because a lot of players have increased the cement prices.
Yeah, they are improving, but the demand is weak because of the construction activity is not so full. But the demand is, and you also have logistics issues because material is not moving. But our both plants are working now as of now, and it's fine. But we were shut down for almost about in this more than almost about 40 days actually. So.
Thank you.
Thank you.
Before we take the next question, a reminder to participants to please limit your questions to 2 per participant. The next question is from the line of HR Gala from Finvest Advisors. Please go ahead.
Yeah, hello. I just wanted to know in this CY20, how much capex we would be incurring? We already spent, we said 60 million.
So overall, we expect to be about $120 million in 2020.
Okay. And that will be completing all the projects?
That includes all the new projects as well as the maintenance capex.
Okay. So beyond that, there will not be, and no new projects are coming up in CY21 as of now?
Yes. Yeah.
Okay. My second question is, as our ACP plant is now getting delayed, how are we managing in different markets the availability of GPC, for the CPC manufacture? And I wanted to know what is the delta currently between, say, CPC price and GPC price, if you can help me.
See, from an ACP perspective, the main thing that is going to impact us is only for the SEZ project mainly, the delay. But since we have delayed the SEZ project also by a couple of quarters, we are going to be producing only sometime in third quarter. But we have enough, we'll be procuring for initial phase, we'll be procuring raw materials from within India and maybe other sources we are evaluating. So hopefully by first quarter we should be in production for the ACP plant, so we should be fine from a raw material perspective. Mm-hmm. And basically on the margins between GPC and RPC is just normally if you see in Q1, kind of we are near the normal levels.
So how much it is? Like say for example, in this quarter we have $235 CPC price average. So against that, how much is the GPC price?
See, it varies, in which country you are, but average, I would say normal is about $70 to $80 is the difference margin, sir.
Okay, difference is 70 to 80. Okay. Thank you very much.
Thank you. The next question is from the line of Gunjan Kabra, who's an individual investor. Please go ahead.
I wanted to ask that, there's a slowdown in the aluminium industry expected, or rather I should say it's already been persisting since last 3 or 4 quarters or maybe more than that. And COVID had just accelerated this trend further. But the volumes and the margins in the carbon segment, we have been able to maintain it. And since the last 3 quarters, we have been improving. So there's a huge uncertainty in the market, inventory being piled up. So, and this is a scenario which we have seen for the first time. So I wanted to gain a perspective from you. Then how do you see volumes and margins going forward? And I see that the customers are some of the leading companies and they have been able to maintain their production numbers at a steady rate. So is it fair to assume that we can expect a decent demand for our carbon segment?
Jerry?
I'm sorry, I didn't catch the question, Jagan.
Gunjan, can you please repeat one after other? You are combining 3-4 questions into single one.
No, my question is basically, sir, our customers are the leading producers of aluminium, and they have been able to, maintain their production numbers at a steady rate since last 3-4 quarters also when there was a slowdown in aluminium. So, is it fair to assume that, the demand or the volumes can remain consistent going forward with our margins? Because even if there is a slowdown in the last 3-4 quarters, also we have been able to maintain our CPC volumes. So, can we do that now?
I think I understood a portion of what you said, so I'll try to respond to it. Right now, as far as again, in the CPC segment, we are still producing. So we are only minorly affected in volumes from the U.S. Versus our expectations for the first half. Now, margins are still an area that we're focused on. As we said, we're realizing some higher prices for our lowest sulfur components, our ultra low sulfur raw material supplies. In India, we've seen some volume impact. We did take down also our operations there, which means some higher costs that we're realizing. And we are seeing the same higher cost for raw materials. So that will impact us. And I did hear you reference the last 3 quarters where we were establishing, better margins overall. And first quarter was a nice, healthy margin as well. So yes, we are concerned. Looking forward, what we're focused on is obviously most important to us is what is going to happen from a volume demand perspective. The aluminum industry, the aluminum price has been down. Okay, that concerns us. We're at least pleased that the LME that was in the 1400s range is in now a 1500s plus range. That's a positive. But there's so much speculation in the market right now of what's going to happen to the LME aluminum price. You have half, 2/3 of the people saying it's going to weaken and 1/3 saying it's going to strengthen. So this is why we're taking a wait and see approach to what's going to happen. In the absence of major curtailments, we're reasonably comfortable with our ability to weather this storm in the calcination business. Okay, but like we're saying, we've not seen something like this before. The world has not seen something like this before. So obviously we are hoping for the best, but we are planning for the worst. And we have several different layers of contingency of what we would do if we do see reduced demand. So I know that's not exactly, it's not an exact pointed answer, but that's really probably the best reflection I can give you of how management is approaching this and what we're experiencing now and what we're watching for developments for in the future.
Okay. So one more question I wanted to ask is that the debottlenecking in the CPC business was done last year in 2018, and the premise was to allow flexibility of using either coal tar or petro tar as a raw material. So, the unprecedented fall in the crude oil prices, can we expect a better margin or the raw material efficiency can be maintained with the usage of this raw material, and can this be an advantage to us?
Yeah, that's a good question, and actually an astute observation. Here's what we're looking at from the coal tar perspective. You're right to say that coal tar prices are coming down from that perspective of the liquids component that we get. When we price coal tar with steel producers, there is the component of the value of the pitch that's in that product as well as the value of the liquid products. So coal tar prices have come down related to that. So we do have a bit of an advantage there with what's happened. Now, what we're careful at watching is that will not remain very long if not enough coal tar is available, and just demand factors take over in a market that's undersupplied because of the availability of coal tar. So we're cautious to make any forward-looking comments related to that. And obviously, the demand for our pitch product is going to be highly dependent on that continued demand from the aluminum industry going forward and whether we see curtailments. So making a comment on, in the way that you presented your question, in a sense, yes, in just looking at it from that one angle, it could provide an opportunity for better raw material cost for us going forward. However, these other mitigating factors, we have to watch how they play out in order to say that, yes, it would actually manifest itself to a benefit for us.
Okay. So thank you for answering the questions. Thank you so much.
Thank you.
Thank you. The next question is from the line of Darsh Solanki, who's an individual investor. Please go ahead.
Hello.
Go ahead, please.
Yes, thank you for taking my question. I wanted to ask you that the 7.25 USD denominated bonds, can they be prepaid earlier? And since, the interest rates in the US have almost come down to zero, would it be possible to refinance this at a much lower cost?
Which bonds? We have bonds having interest rates of 7.25% now. So these bonds are repayable in April 2025, and we have a call option coming from April 2021 onwards.
Okay. So considering the amount of cash we have, do you think you all will exercise the call option? Because 7.25% in dollar terms seems like a pretty high rate.
Yes, basically as we generate more cash, actually we have as Srinivas mentioned, we can actually start paying off the debt, but if we don't want to pay any with some penalty, but otherwise, or we can also pay off our debt in Europe, the Euribor loan without any penalty. So we will decide. And also there is a cash sweep mechanism as part of our loan covenant. It's basically, if you have any surplus cash, we have to use that to pay off the debt. So far, because we've been spending the money for capex, so we needed the money, but not going forward, as we have the money, we'll actually start using the money to pay off the debt.
Okay. And I wanted to ask you, what is the total capital being invested in the HSCR plant? And could you give us some idea about the end use of the whitewater resins and the different industries?
See, the total capital, between the ACP, HSCR, and the shaft cal is about $200 million.
No, I'm just talking about the HSCR plant.
HSCR is about $100 million.
And could you describe what is the end use of the whitewater resins and what industries does it cater to exactly?
HSCR basically goes into the hygiene industry, packing industry. For example, all the diapers, all these hygiene products, it's needed. For example, now, the PPE, what is going to be needed, for all the plants around the world, the PPE also will be used, HSCR will be actually used for those. So it's a product, basically it is probably a very clean product.
Okay, thank you so much.
Thank you. We'll be able to take one last question. We take the last question from the line of Arun Loharka from MH Capital. Please go ahead.
Hello. With the risk of repeating the question. I just wanted to get this as to for the projects that are still outstanding, which you have delayed. What is the capex that needs to be incurred there?
We have to I think between all the plants we still have to incur about $35-40 million. $40
million. So if were to
actually, as we mentioned, we have $120 million this year, so that should be sufficient for most of the projects.
Yeah, and is it going by the current run rate, the cash generation of from operating cash flow of close to 400 to 500 crore? Is it safe to assume that the company will be able to maintain that run rate?
What operating margin?
Cash flow
crores? Yeah. We should be able to do that.
Thank you.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to Mr. Gandharvi for closing comments.
Thank you all. Rain is in a unique position in that we are an essential part of the global supply chain. With that comes significant responsibility to our customers, communities, employees, and investors. And we are doing everything in our power to ensure that we meet the expectations and requirements of all our stakeholders during the extraordinary period. Prior to the pandemic, our business had generally returned to normal. In fact, if you look at our LTM EBITDA, we have been at our historical normal, almost historically normal levels, and had consecutive strong quarters for CPC volumes. That said, we are watching the markets closely, very closely, and we are prepared to react as needed. We understand that the future is cloaked in uncertainty, and we are prepared for any eventuality. We are also taking several proactive measures to reduce, eliminate, or delay spending that does not provide a materially beneficial impact to our operations or our customers. At the same time, we are taking stock of what we have learned during the past 3 months while managing to keep all our plants running and our employees free of work-related coronavirus cases. Since the pandemic began, we have become smarter and more efficient in how we run our businesses. We now need to capitalize on what we have learned and how we have adapted to make us a stronger and more competitive company. Thank you for joining us today, and best wishes for the health and safety of you and your family. We look forward to speaking to you again in August. Thank you.
Thank you very much. On behalf of Rain Industries Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen.